Good evening, Shamika ma'am, for gracing the occasion. Good evening, sir. Good evening, B. Gupta ji. So, when this opportunity was given to me, I hope you guys can hear me properly. I'd like to be walking, and let's make this session as interactive as possible. I have been given 40 minutes, and I like to do justice with respect to the time which we are spending out here. Unfortunately, considering it's a very mixed audience, I have curated my presentation primarily across most of the subjects where I can touch upon this. Wherever you feel that you need additional information on that particular topic, please interject and ask questions. Is that clear to everyone? Disclaimer first, although I never tend to give any specific name of any product or specific stock or any mutual fund, but just for the sake of explanation, in case I happen to give any name, please don't act on it. 3 pillars of SEBI, primarily 3 important aspects. First is development of securities market, regulations of securities market, and investor protection. And we are here primarily both for the development of the market as well as protection of interest, investor protection interest. Okay. This is a broad structure of capital markets, SEBI in between, investors, stockbrokers, investment bankers, which are registered intermediaries. Then, of course, there are companies, social enterprises, and of course, there are MII, which are primarily stock exchanges and depository participants. I'll brush upon very quickly. I think these statistics, more or less, it's been taken care of. It's talking about the growth of India. And please understand that whole world is actually investing in India, and it gives me immense pain when I find that, our investors primarily, our people, are not using these opportunities. So this is the just 3 decades of mirroring India's growth. I wouldn't spend much time on that. These are current statistics primarily. We have close to 12 crore plus unique investors. We are covering 99.95% of the PIN codes. 23 crores in totality. 1 in every 4 households are holding some shares. And this in last decade, it is 7 times the growth which you have seen. Average age, 69% is less than 40 and 31% is more than 40. Gender also you can see 25% female and 75% male. This briefly about NSE. We are the largest stock exchange from derivatives contract perspective from last 6 consecutive years, 3rd largest equity exchange, largest multi-asset class exchange. We have got 12 crore unique investors, briefly 2,900 plus listed entities. This year we have done close to 19,000 odd programs pan-India. Which touch based around 9 lakh individuals. And we have covered almost all districts. 782 districts we have covered this time to make sure that the penetration is absolute. Now it is primarily the core content of why we are here, financial planning. Unfortunately, it is never taught in school. Just like ma'am has given an example, even when I have joined first, I started earning, the first person who has come to my door is primarily the insurance agent. I won't name the company, but you know how they sell their policies, correct? Most of the time they end up selling endowment policies. When you see the returns on those endowment policies, it's hardly 2.5%. This, yeah. Or if you are feeling an echo, or I need to increase the volume. Anybody knows this gentleman? Everyone knows? Okay. Thankfully, yes, I don't get these kind of answers when I do the program elsewhere. So, yeah, why I've exactly specifically posted his picture is, I'll be referring to some of his quotes quite often as part of this presentation. So that's his first statement. An idiot with a plan can beat a genius without a plan. Unfortunately, when it comes to financial planning, we never plan. And it is almost most of the time. This is a very famous Stephen R. Covey 4 quadrants. So primarily the first quadrant is those things which are very urgent and important. Second quadrant is important but not urgent. Can anybody tell me where exactly the financial planning lies? It is almost all the time in second quadrant. We don't realize that these things are very important and we need to act today. The more you delay as far as financial planning is concerned, it is going to bite you much harder. So,
can we get you for questions or later?
As you wish, sir. I am okay. Okay, that's okay. Okay. Okay, so what is primarily financial planning? Very importantly for us, one is, we always suffer from something known as herd mentality. Lot of times, मेरे पड़ोसी ने ये किया, मेरे परिवारजनों ने ये किया, we end up replicating the plans which they have followed primarily as far as financial planning is concerned. The unfortunate part is, two individuals are very, very different. Their financial status are very, very different. Their financial goals are very, very different. Their aspirations are very, very different. So at no point of time you can replicate whatever somebody has done, I should replicate that. So somewhere down the line, we need to pen that down. What are my financial goals and how I am going to achieve about this? So there are broad buckets which we can put it across as far as financial planning is concerned. The first is goal setting. Then of course into budget it across, then investing, protection when we talk about insurance, whether it is a life as well as journal, then of course tax planning, and estate planning is primarily your succession, how you are going to do about that. So this is the data, it's like, empirical data which suggests that, most of the time 78% of the people live paycheck to paycheck. They haven't planned much, correct? Very importantly, and my father used to say, correct, whenever you want to do something very serious about it, please write it down. Make sure that you pen down what are your financial goals at every point of time, and then accordingly act on that. And in India, typically the situation is a big problem for us. 60% of the retirees are going to outlive their savings without planning. Unfortunately, almost all of us don't have that kind of pension plans which are available, wherein it is supported by government. Our longevity of life is increasing. Culturally, we are moving towards a Western society where, earlier, your kids tend to take care of their parents. I don't know how we are moving now. So this becomes very, very important because of these aspects. Your longevity is increasing. Plus, of course, you are not very sure whether kids are going to be supportive of your retirement. So that becomes an important aspect. These are brief steps in financial planning. You plan it, you invest it, review it, and continuously the cycle goes on. Okay, some core principles we'll see in brief. First is pay yourself first. That means you need to save first. So it's like, income minus expenses is like saving, correct? So decide on saving how much you want to save, and then spend it out. So that becomes very important. So it's like Warren Buffett quote again, do not save what is left after spending, spend what is left after saving. Secondly, I think this becomes very critical for nowadays, primarily. One is, the area of concern is primarily lifestyle inflation. Everyone wants an Apple iPhone 17 Pro. The very same utility phone, you can get it from the other options which are available in the market. We are actually moving to that kind of a culture. So please understand whether the instrument which you're buying, whether that is solving the utility for which you are kind of taking that phone. I use a very medium range phone. Most of the features I never use it. It's only 3 or 4 features which generally use it. Right? That's there. Okay. Housing. Now the point is, unfortunately, culturally, we are like, we need to have a big house. There is a dream of everyone. And we end up taking as much loan as possible for that asset class. Not knowing that, in case you end up paying after 25 years, you end up paying nearly more than double to the financial institution from where you have taken the loan. Then of course, every now and then you need to finance your new cars. So these are like wealth destroying habits. Similarly, I put across what could be the wealth builder habits. Okay, very importantly, first of all, whenever somebody starts earning, the first thing is you need to start taking care of the insurance part. The first thing which somebody when start earning should be, they should buy a term policy so that his life is getting covered. 2 advantages. One is, when at an early age, when you take a term insurance, it costs you very minimal. A 1 crore insurance, primarily if at the age of 18, you end up paying 6,000 or 7,000 rupees as the annual premium. You end up buying at the age of 40, 45. Most of the time they will say no to you. And if at all they are going to give it to you, it is like 50, 55,000 kind of a premium which you have to pay. Insurance is very cheap when you're young. So that's the first thing which we always advise people to get it as soon as they start earning. First cover your life and then of course your health, unless it is of course covered by your organization. Ma'am has also spoken about that, and sir has specifically asked question that, now you don't stay in one particular organization, you keep on shuffling jobs. Many of the time because of XYZ situations, you are out of job. So make sure that at least your 6 months salary at least should be in saving instrument, hardcore saving instrument for your emergency expenses. That is foremost. So first build this, then of course we can talk about investments and all. Eliminate high cost debts. Typically your credit card debts are very, very high cost, even your personal loans that are high cost. So don't end up taking those debts. Common, because your wealth needs to be compounded. It is always said that the more you start early, that is better. That's what Warren Buffett has been asked. Somebody asked him that what is your biggest regret in life? He said, I started investing late. He started investing at the age of 13. So the early you start, that makes more sense. Diversify across asset classes. Now, it's a common principle, correct? So diversification holds the key. But just like Warren Buffett said, correct? Diversification is protection against ignorance. It makes little sense if you know what you're doing. So if you are completely ignorant about things, it is best thing to kind of diversify your risk primarily across your asset classes, which can be anything. It can be gold, it can be land, it can be real estate, it can be debt, it can be equities. A lot many things you can diversify across. Also, when you are making the diversification, also make it a point that you diversify across different service providers. So take an example, don't buy a mutual fund with one particular entity. Make it across different. Even in equity, there are multiple options which are available. There are hybrid funds depending upon your need, which is available. There are large cap, mid cap, small cap, micro cap. Depending upon your need, you can actually classify, and then accordingly you can make those investments. Understand risk versus return. Absolute. Any return without any kind of risk, what you're taking is actually meaningless. Somebody tells you that, I am giving like 15% of return. You should ask that, okay, 15% return, but against what kind of risk you are going to take when it is like financial risk. So return in isolation without risk doesn't make much sense. So it is always directly proportional. The higher the risk you take, the more the chances of returns you are going to make. So there are different type of risks, of course. Market risks are primarily now what is happening in the markets because of a lot of geopolitical crisis and all. There is a big market risk events which are happening. Inflation risk, your purchasing power is going to deplete every year. Liquidity risk, please don't put your investments in those kind of instruments wherein, whenever you are in need of money, you are not in a position to liquidate those. Credit risk, of course. Credit risk is primarily when you are actually, you have given the money to someone and he says, no, I cannot give you back. Concentration risk is primarily don't kind of concentrate in one particular asset class or one particular scheme. Okay, and of course, yes, tax efficiency becomes foremost. So please understand that whatever returns you are generating from your investments are going to be taxed. So please select those instruments which are more tax efficient as compared to others. We'll talk about some of the taxation with respect to different asset classes also in brief. Okay, so this is, I would say, the chart which primarily everybody needs to understand. It's a very simple chart, but at least these are the criteria when you actually evaluate when you are making any kind of investment decision. The first one is safety. When I talk about safety, can anybody tell? Safety of what? Of a principal, correct? And of course returns also, both, right? But principal, a lot of people go after return, but please understand that the person to whom you are writing the check or you are transferring NEFT, RTGS or IMPS, whether that person is actually a registered entity or not. A lot of capital market frauds you have seen in last 1.5 years where people have actually written checks to people who are rogue elements and they have siphoned off money outside India. So please understand that before writing a check or transferring money, please understand whom you are writing to. Now, the question should arise, how exactly I am supposed to know that whether that person is right or wrong? So very simple answer. So those entities which are registered with any of the regulators, primarily 4 regulators, is the Bank of India, SEBI, PFRDA or IRDA, insurance regulator. Those entities who are coming to you for any kind of product, please verify whether these people are registered with those regulators or not. That is one. Second thing, typically around capital markets, you would have seen a lot of capital market frauds happening last 1.5 odd years. SEBI has recently introduced a very good check, which is known as SEBI check, which talks about that anybody who gives you a scan QR code or maybe a UPI ID or a bank detail, SEBI has given a functionality to check whether that particular UPI code or QR code or the bank account is actually of a registered SEBI intermediary. There is a very simple check which is available. You have to go to the SEBI website, put the UPI ID or scan the QR code or put the bank details. In case that entity is registered with SEBI in any manner, it will show you a kind of a triangle with thumbs up, green triangle with thumbs up, which shows that, okay, this is the entity whom I can transfer the money. Lot of frauds, capital market frauds which have happened, you would be surprised to know that, when they have transferred the money, that the entity to which the money is going, it has nothing to do with capital markets. Even the name was suggesting that it has nothing to do with the capital markets. It was some apparel company or some garage entity or some kind of entity which, from the face of it, it is looking like that this entity has nothing to do with capital markets. So that's the first check when you are transferring money you have to take care of. Second is liquidity. I think liquidity, we all understand that how quickly you can convert your investments into cash. So that's important. Third is returns. So I'll come back to returns primarily. So out of the audience, what kind of returns would be okay for you guys, just from the sake of curiosity? More than inflation. Very good. So sir is saying more than inflation. So inflation is around 7%. So sir is saying 8% is okay. 9% is okay. Any other numbers in the public? 12 to 15%. Okay. But still, what you feel that, say this percentage would be okay for me? 20%? 2 to 3% above FD. Okay, so okay, I understand. Maybe 8, 9, 10%. Any other 21 दिन में पैसा double कोई है? Anybody? Yeah, that's a deepfake video, ma'am. That's absolutely a deepfake video. Yeah. Nirva Satyaram and do a lot of works to do rather than coming on deepfake video, making a video on that. Okay. So we'll talk about return specifically, so because somewhere down the line, our expectation of a return is also a very important criteria, which which actually forces us to make a wrong decision. Yes, sir.
And the liquidity. Remember that, risk, return and liquidity. So higher the risk, higher the return is a general principle. But liquidity is very important. If you have a lot of real estate investments and you really need the money, you will not be able to sell it in the next 6 months. Whereas something like an equity investment, within 2 days you will, and thank you SEBI, we have a T+1 settlement. So within 2 days you'll get the money or the shares. So remember this, risk, return and liquidity. And ma'am, let me assure you that deep fake videos are getting smarter and smarter. So very often you will actually get very credible people recommending something, including your own family members. Please do not believe this. Deep fake videos are going to, with artificial intelligence, become much more realistic in the next 2 years. So, soch kar, samajh kar, invest kar.
Thank you, sir.
Yes, sir.
Please.
No, please go ahead. So, 20% return.
See, this is a common saying that high risk, high return.
That's right.
Now, as an investor, I would like to know what risk is reasonable and what risk is not reasonable. What appetite I have for that particular kind of risk, right? So nobody tells us that. This is a general thing. So now you are telling a common investor that आप सोचिए समझिए इन्वेस्ट कीजिए. अब आप 4 एडवाइजर्स भेज रहे हो और वो अपनी ऐसी आपको चीज़ें बताते हैं, उसका सुनो आपको लगता है सही कह रहा है, उसका सुनो आपको लगता है. So ultimately, is there something in your course which enables a person like me to become slightly more, you know,
We'll talk about
Joginder,
that, sir.
you'll talk
Yeah,
about
we'll
it,
talk
but
about that, sir.
I'll
It's a
just
valid-
give you two
very valid
inputs here.
question.
I'll just give you two inputs because I'll also excuse myself. Input number one is, there is a concept of a financial advisor who gives you services for free. There is nothing called free. That person is getting a commission on everything that advisor is selling you. So if that advisor is selling you insurance, you can be sure that he's getting a commission from the insurance agency,
Yeah.
right? But there is a category of SEBI called Registered Investment Advisor, RIA, right? Now the RIA has to give an undertaking. It is not, he is or she is not taking any commission from anyone else. He is only charging you fees. So an RIA is expected to be more loyal to you than someone who's giving you advice for free. And there is a list on the SEBI website of recognized RIAs, registered investment advisors. Any of them, they have all been authorized by SEBI. Yeah? Right. On the SEBI website. Yeah, so their contact details are there on the website.
You as an IA, listen to me, ask for my number, the code that we give, cross-check it on the SEBI website.
So check the, exactly. So SEBI website actually is a great resource. The only other thing I'll say is, because capital markets can go up, can go down. And typical financial planners will say, when capital markets are very high, you should balance portfolio and get some fixed income. And when they're very low, you should pile into equity. But that results in capital gains. And capital gains tax is best avoided by investing in something called the National Pension Scheme, because you can change the allocation between debt and equity and corporate and government bonds. So these are the only things that I wanted to add. Back to you.
We'll talk about that, sir. Yeah. Yes, sir.
This is regarding the risk.
Yes, sir.
When we invest, we are putting some abstract number. But when we talk about risk, it is high risk, moderate risk, and low risk. But suppose this is in statistics language, we always can calculate risk as a probability.
Correct.
But when we talk about this investment sector, it is only about these three figures which we get, that it is a high risk investment, this is a moderate risk, this is a low risk. So on the basis of these three categorization, how do I calculate and estimate my abstract value of risk?
No, it's a very pertinent question what you said. So one is, please understand that measuring risk in isolation won't work, correct? So risk, so a moderate risk for you would probably be a low risk for somebody else. The risk appetite and the risk tolerance of everybody is very, very different. Now take an individual who do a good amount of wealth and he want to punt some section of maybe 10% of his portfolio in a very, very highly risky assets just to kind of increase the returns. That is also a possible situation. Or maybe a situation like wherein a person is 55 years old, he's on the verge of retirement, and he wanted a kind of a steady state of income coming to him post-retirement, correct? For him, I think he would be a very, very low moderate or kind of a low risk kind of a product he need to take care of. Unfortunately, with most of the advisors which primarily comes, and SEBI has rightly mandated it, that whenever an investment advisor comes to you, it is pertinent for him to understand your financial needs, understand your risk tolerance and risk appetite, and what are your financial goals. So these three things, if somebody evaluates it properly, and if we do justice to his job, he is going to always advise you the right product. Unfortunately, people don't do that. They are, just like sir has given an example, they would like to throw back that product to you, which is going to give you the maximum amount of commission for him. Lot of mutual fund distributors, correct? I don't know how many of you utilize their services. What they do is, they will ask you to put in that particular scheme. After 1.5 odd years, they will primarily say, oh, your scheme is not doing very great, sir. Why don't you churn your scheme to something else, which is flavor of the market? The point is, people need to understand, whenever a new NFO is coming, that the commission rate which are given to that particular distributor is much, much higher as compared to if it is like, you are holding it for quite a long period of time. So I think all these things people utilize because they feel that, one is we go by whatever person is saying, we believe very easily, typically. वेरी सिंपल एग्जाम्पल, मोस्ट ऑफ द टाइम हम लोग सब्जी लेने जाते हैं ना, 50 रुपये का सब्जी होता है, 50 रुपये का टमाटर रहेगा ना, वो भी 4 बार घुमा के देखते हैं. करेक्ट. व्हेन इट कम्स टू योर हार्ड कोर हार्ड मनी, वी बिलीव ऑन वॉट एवर समबडी इज सेइंग. या मेरे पड़ोसी ने क्या किया है, मेरे फैमिली मेम्बर में किसने क्या किया है, आई विल काइंड ऑफ रेप्लिकेट द स्टोरी. सो आई थिंक समवेयर डाउन दैट वहाँ हम लोग को ज़रूरत है टू काइंड ऑफ.
If I can just add briefly, sir, you will be above 40. This young lady will be below 40. नहीं, this young lady will be below 40. इनका risk perception और आपका risk perception अलग है. She has another 20-30 years to go to accumulate. अब आपको she can afford to take more risk. अगर आपको अपने पोर्टफोलियो को बचा के रखना है, you should move into lower risk gradually. That is number one. Number two, अगर आपको कोई सामान बेच रहा है, इसका मतलब उसको कमीशन मिल रहा है. अगर कोई सामान आपको कोई नहीं बेच रहा है, जैसे नेशनल पेंशन स्कीम, that is very safe for you, because that is not giving anyone commission, and that is why nobody markets it.
A valid example, sir. Very valid.
But that national pension scheme is only until you are 60.
Actually, now I think they have revised the age. नहीं
till
ऊपर कर दिया है. नहीं, one second. Till
No,
when?
no, I think 65 if I'm not mistaken.
I think 65 or 70, but I'm saying you have people in your family. आप कोई भी 18 साल के ऊपर का हो, आंख मूंद के NPS खुलवा दें. And it is not only for government people. I have had a national pension scheme out of government for the last 15 years. Let me say, in terms of risk, in terms of liquidity, in terms of return, it is the best product in India today.
One small question.
Yes, sir.
I'll give it back.
Yeah.
One small question. Everybody, all the advisors who come, they say, when I have read Warren Buffett quite, and he says just invest in the index fund.
Okay.
And if you're a long-term investor.
Correct.
None of the advisors will advise you to do that.
Yeah, because
Why?
sir, the very same answer. So if you see index funds, typically which is given by mutual funds, their expense ratios are comparatively very, very less because there is no active fund management. So that's the reason usko nahi milta hai, that's the reason they won't do it. It's as simple as that. Yes, sir.
We are sitting here and probably everybody is talking about in favor of DMAT. Probably sir has a better investment than DMAT. I would
Yeah,
say.
for sure.
Sir, when we talk of liquidity, sounds very good. There was a COVID time, and today liquidity doesn't mean that I have put 100 rupees, it's available, I have a requirement, so I'll take it at 70 rupees. I'll not do that. That is not liquidity. Now, at this moment of time, probably for the next 3 months, this liquidity word doesn't have any meaning because the moment you are selling off, you are losing a huge amount of money. Any share. In at least 80% of those NSE listed things you will see, they're almost close to or at about 52 weeks low. So that liquidity part is not so, encouraging as it sounds at the moment. And another point I would like to say, rather it's not a comment, it's just an observation. Everybody, whether it's Warren Buffett or anybody, probably one of the major things when we are investing is governance.
Correct.
Whichever company is doing well, has a good governance, will bring you the money in the long run. But see today, HDFC chairman, even RBI says how abrupt he has gone, and HDFC has appointed 2 major companies here and 1 from abroad to investigate what was wrong. And the chairman has said there is something wrong in governance. A bank, a company like HDFC, if it can happen there, how much we trust. But my last sentence is that in stock exchange, in investment, everything is uncertain. Otherwise, everybody would have made money and nobody would have lost money. Thank you.
Sir, all the points are valid. I'll try to cover these points as part of this. Yeah. So one thing is very clear when you talk about liquidity. I think somewhere down the line it is slightly misunderstood. Say, take an example. When you are in need of money, say, when you are in need of money, whether you are quickly in a position to kind of transfer that asset into cash. That's liquidity. It can be a fixed deposit also. A fixed deposit they have a lock-in period of 6 months, correct? If you withdraw before that, there is some penal amount which is applicable, correct? Yeah.
It's not in every bank now. Many of the banks,
Correct.
premature, withdrawal.
No, so that's what I'm saying. I'm not talking about any particular asset class. I'm only a basic criteria when you are evaluating an investment. That's the only limited point. Okay. Ticket size is primarily how small or big you need to, the minimum ticket size that can be done. Typically, unfortunately for real estate, our ticket size are very, very significant, correct? You cannot end up investing, like, if you want to have a real estate, not in 5 lakh rupees, correct? That would happen. Taxability of earning and then tax reduction. Okay. So, sir ka question, sir, aapka bhi question is a very common parlance. What we do is, what we do is, when you want some kind of a asset allocation, it is generally your 100 minus your age. Typically, you go by that criteria. So, if you're 60 years old, primarily 60% of your assets primarily would be in a very fixed kind of instruments. When you're young, 80% of your instruments, if you are 20-year-old, 80% of your instruments you can actually put across in those asset classes which give you better returns than your inflation and all. So I think that's the sir was also making a point. Okay, I'll quickly talk about this, and I need to rush up primarily on this. Okay, Berkshire Hathaway is a company of Warren Buffett. His last 25 years compounded annual growth rate, this is a question for you. The second question is last 25 years Nifty, how much return they would given, that's a question to you. So it's primarily why I've said that, your expectation of a return is very, very important. Somewhere down the line we feel that, these returns are not very significant. It is very important that how long you are going to have your investments that are going to give results. Okay. I think all of you guys have mutual funds, so I won't put much effort over there. Everybody invests in mutual funds? Okay, so I won't specifically put much time over here because the only thing primarily you need to think through is what kind of mutual funds you are selecting. Secondly, if you are selecting on your own, please go with the direct plans. Direct plans are available where you go directly on the AMC website and make the investments. Because most of your investments are for long term, even a minor difference in NAV would make a huge difference at the end of the day. So one is a direct plan. Every scheme have 2 plans. One is direct plan, wherein no commission is distributed to any of the distributors. The second is a regular plan, wherein some kind of expenses goes to the distributor. So you check any of your plans which you are having and see what is the NAV of direct and what is the NAV of regular. If you are making your own decision, you have yourself put all the efforts to select that particular scheme, it is always better. Go on the AMC website, and there are certain apps available where you can directly make the direct investments. That becomes important. Okay. ETFs is also very, it's an important product. It is primarily, the construct is absolutely like a mutual fund, but it gives you much more flexibility. These products are available on the stock exchange, they are traded on the stock exchange, and their expenses comparatively are comparatively lesser as compared to most of your mutual funds. So it gives you one more product option. Typically, most of our investors actually, when they invest in mutual fund, they do a SIP route, which is systematic investment plan. The only flip side of SIP is it gives you a bit lesser flexibility. Some of the months might come wherein you don't have that kind of money to invest in, correct? And some of the time, you do have larger corpus which you can invest in. So it is easily managed in case you are doing through ETF. Okay. Taxation, I think, hope everybody is aware of. So primarily all the debt instruments primarily which comes in, whatever interest income or say if our debt instruments you get some kind of a capital appreciation across those bond prices, all are actually taxed as per the available slab of the person. In equity, it is like 12.5% is long term if you hold your investments for more than 1 year, and short term is 20%. A lot of people, I don't know how many of you would, I believe everybody would know that there is 1.25 lakhs of tax exemption which is available of every financial year to every individual. So please make use of that. Okay. There is another class of investment which is primarily InvITs and REITs. REITs are, the construct is more or less like a mutual fund. It actually invests in real estate properties, commercial real estate properties, which are income generating. So whatever rental income that comes out of those commercial properties, those are handed over as part of returns to the investor. So that becomes a regular income scheme. Of course, please understand that whatever real estate they are going to buy, the Even the prices are going to appreciate, even the rental incomes are going to appreciate. So the price of REITs and InvITs also increases. So those people who are actually looking for any kind of a product which gives you a regular income around say 8 to 10% with a capital appreciation, this can be good option if you want to have that kind of exposure in real estate. That's there. Government securities. These are also good class of product, typically on the fixed side, fixed instrument side. A lot of people go with FDs and all, but today if you want to go to a bank and ask them a FD of 20 years, they're not going to give you. Because most of the FDs are primarily to 4, 5, 6, 7 years. There are of various tenures, all the government securities are available. If you want to do it for like 1 year, T-bills are available. Then of course there are government G-Secs available, even state securities are available. So these are guaranteed by sovereigns. So these are comparatively risk-free. And it gives a decent, I think 50 basis point plus to your fixed deposits and all. This can also become and Reserve Bank of India has also given a option where, earlier the ticket size of these investments are very huge. Now they've reduced that ticket size. Minimum is 10,000. There is an app which is a retail direct app from Reserve Bank of India, which you can use it for making investments in this. So that becomes a good handy instruments. Derivatives, I won't spend much time to primarily here. So, okay. Sources of due diligence, it's primarily we talk about how we are going to analyze a particular mutual fund or particular company. So it's a top-down or a bottom approach. So in case you are identifying a particular stock, then first you identify in which country it is, which industry it is, what company is doing. So it is primarily, it involves everything regarding what are the profitability of the company, what are the turnovers, what are the expansion plan, what are the governance that is spoken about, right? All these impact the fundamental analysis. So these are fundamental analysis of this. Okay. I'll spend 5 or 10 minutes here primarily, and after that we'll wind up the session. Lot of retail investors make investment decisions. Almost everybody make decisions. Unfortunately, we end up making decisions which are wrong, and you have studied everything. You have made all the research. Despite that fact, you end up making wrong decisions. It is because of the cognitive biases which are there with us. We'll give some examples, and I want to. So the Daniel Kahneman is the Nobel Prize winner of behavioral economics, and ma'am has also spoken about that. So when somebody asked that person that whether people are rational or irrational, his statement was they are inconsistent, emotional, and easily fooled most easily by themselves. So we'll have some examples for you to kind of better understand. Okay. Now, how many of you actually traded in stock market? Sir, aapne kiya? Anybody else? Okay. So very simple example. You have taken a stock at 100 rupees. In 10 days, that stock has become 110. Now, 10 rupees gain has already come to you. Your fear, there are two emotions, fear and greed, correct? Your fear psychosis kicks in. ये 10 रुपया मुझे जाना नहीं चाहिए, correct? You end up selling that stock. The other example, 100 rupees, it becomes 80. 20 rupees loss. Or maybe take example 90 rupees, 10 rupees loss. That 10 rupees loss pinches you double as compared to the 10 rupees gain, the benefit you are getting it. Hey, yes, sir? Everybody agrees? Absolutely. So what do? Huh? You do averaging. 70 रुपये में वापस खरीदेंगे, फिर 40 में खरीदेंगे. ठीक है? So it's a bias, correct? So take another example of biasness. आप में से anybody who works in any particular industry, say any specific industry you have worked upon, say which industry? Power and energy. Now sir has invested in power and energy. Now because sir understands power and energy, he is very much likely to invest in those stocks or companies which are in power and energy. Yes or no? No. Good. Thankfully you are not suffering from that bias. But the chances are that. Because of which there are very less diversification. एक तीसरा भी bias है, which is known as overconfidence bias. तो सब में है, मतलब मैं सबसे शाना ऐसा, ठीक है? अब उसमें होता क्या है? आपने सब रिसर्च कर लिया, पहले तो रिसर्च कर लिया, सब कंपनी अपनी देख लिया, and then you end up buying a particular stock at a whatever XYZ price. The point is you have so much of confidence in yourself that it cannot go wrong. Situation changes, correct? At some point of, and best part is there is another bias which works here. So in case you've already bought a stock, you will always overweight a news which is matching to your decision. You bought a particular stock, and then some news comes in that this particular company is actually entering into some kind of a merger or expansion, and there is also a negative news which is coming. But you are always going to discount that particular negative news because of your biasness. So all these bias. There are other couple of biasness also, correct? से आपने कोई भाव जिसने ट्रेड किया उसको पता रहेगा, आपने 500 रुपये का कोई कंपनी में भाव देख लिया 500 रुपीज़ का, करेक्ट? अभी बिकॉज ऑफ XYZ रीजन 300 रुपये हो गया, आप अपना व्यू 500 पे एंकर करके बैठे हो कि यार मैंने 500 का भाव देखा हुआ है, 300 में यू लैप अप, यू डोंट रियलाइज दैट सिचुएशन इज ऑलरेडी चेंज, वो 300 में भी ओवर वैल्यूड है, करेक्ट? सो ऑल दिस बायसनेस unfortunately works against us. Otherwise, very simple thought. Everybody has studied probability, correct? If you blindfold me and ask me to pick, say, 200 stocks, 200 is sensibly large number. The chances are that I am going to 100 winner, 100 loser. I may pick, correct? And despite that fact, everybody makes losses because of these biasnesses. And we don't realize these things are acting against us. So that's the reason I wanted to put some time and effort on this. Sir ने किसी ने example दिया था calculus का. Sir आपने दिया था ना? Okay. No. So everything works in play. Calculus भी important है. So d by dx of constant याद है? d by dx of constant differentiation. नहीं याद है. d by dx of constant is 0. So derivative products उन्हीं के ऊपर बने हैं. So if any variable which doesn't changes, उसके ऊपर derivative instrument बनता ही नहीं है. So say all the Nobel laureates who have invented Black-Scholes formula, those were mathematicians only, physicists and mathematicians. Okay, going ahead. Sorry. Anybody do have any questions on this? Yes, ma'am, बोलिए.
You just gave the example of you making 10 rupee profit and 20 rupee loss.
Yeah.
So it is said that cut your losses. What is the stage when you cut your losses? How do you cut your losses?
Ma'am, that's what. It is going back again to sir's question. So in case you are disciplined enough, no, you decided. So any trade you take, correct, very simple. Any trade you take, you don't want to take a losing trade. You say that, okay, if I see a potential of 1:2, that means the chances of doubling it across, maybe I say, अगर 5% आप करके चल रहे हो, 10% में उसको निकाल दूंगा, I'll book my profits, and when it comes to 5%, I'm going to cut my losses.
But then they say stay invested long term.
Correct. So it is primarily with respect to traders. In case you have a conviction in a particular stock and you have studied it properly and you feel that, okay, I am perfectly okay with that particular stock, stay invested. Unfortunate part is, ma'am, when you come to individual stock picking, there are 2 or 3 things which goes against us. That is, one is you need to continuously monitor that particular stock, correct? Secondly, a lot of people don't have that kind of bandwidth and they don't understand the financials. See, कल को उसका annual report read करने को आएगा तो वो 200 पेज कोई पढ़ता ही नहीं है. And that is one. So that, and of course we have a very limited capital. So I would rather, whenever we go to the investors and ask them to kind of make first decision as far as investments are concerned, we say that let us go with a diversified portfolio which is already available. And in case you're going somewhere wherein somebody else is taking a decision, आपके biasness वैसे भी नहीं आएंगे. So take an example of an index fund. Index fund, the fund manager doesn't have any choice, correct? He has to mandatorily invest in those instruments which are there in that index in the very same weightages, correct? One is it's absolutely transparent product. Uska whims and fancy fund manager ka chalega nahi, correct? And you stay long term. So why exactly I asked this question with respect to return? I've shown you a slide. So anybody have an idea how much Berkshire Hathaway or how much Warren Buffett would have earned in last 25 years? 12, 20, 13%. So just see, the world's smartest man, he earns, actual number is 11.96%.
No, but in the long term,
Correct.
also shown
Correct.
that, managers manage funds have actually earned 10% in that time.
Correct.
So index funds
Correct.
actually earn better.
Yes, that's the point I'm coming to. Say, generating alpha. Alpha in the sense you are going to beat the benchmark. Say, agar Nifty is increasing by 12%, your fund is giving 14%, then 2% alpha that fund manager has generated. Generating alpha is not easy task. Nahi hota hai. So it is always better that you stay invested for long run, go in a diversified portfolio wherein expenses are less, and the things are very transparent. So just like sir said, if it is a passive fund, which is primarily your index fund which are there, or index ETFs, those passive funds, if you talk about 15, 16, 20 years of आप उसका returns देखोगे, these guys have beaten the active funds almost all the time.
One more question I have. Given the fluid political scenario now,
Yeah, ma'am.
is it advisable to shift to metal now?
Ma'am, okay, that's a decision you can definitely make. So metal is one of the asset classes, correct? Either gold, silver, platinum, palladium, whatever asset classes are there. If you want to keep some kind of exposures over there, you can do that. It's ultimately your choice. My take is primarily diversify your portfolio, some in debt, some in real estate, of course. See, every asset class do have their own nuances. कल को आपको पैसे की ज़रूरत है, then liquid funds are best or your fixed deposits are best. I personally say that in case any fund which you don't need in, only invest in capital markets, for that fund which you don't need in 3 or 5 years. Anything which, any expenses which you want to kind of take care of, better go with liquid funds or fixed deposits where you can have easy liquidity at that point of time. Okay, we'll quickly run past through this. I think I've touched upon briefly a lot of things. Any specific questions I want to answer at this point of time?
I just want to ask one question.
Yeah.
Sorry, I've asked quite a few.
No worries.
You know, every time we talk to experts like you, we'd always advise that when you invest, do your research well, know the fundamentals of the company, and then invest.
Correct.
Now, as an investor, I'm investing in say 50 stocks.
Individual stocks, okay.
Is it possible for me to do that level of research and study?
So, honest answer?
So what is the advice for people?
Honest answer?
Eh?
Honest answer?
Yeah.
Okay. So, typically, an individual should not diversify more than 20 stocks in different industry. Over diversification kills you, because then you don't have that kind of time, energy, and effort left to kind of monitor and kind of track everything. And there are products which are available. If you don't have that kind of wherewithal, it is better to go with that products. Yeah.
One thing that when we talk of the sectoral things,
Correct, sir.
I think that's probably the whole of the bias comes there. In every sector, there are good companies, there are bad companies.
Correct.
So one has to have a more insight on the either own research or understanding or acquired information.
Okay.
Because in any sector, real estate, there are definitely some of the good potential.
Of course. Of course.
We should rather stay and stay for long.
Of course.
Can we invest directly without going through banks and all that?
Sir, okay, so this is 1 minute. So one is I definitely need a feedback primarily. So because one is I was never very sure of the audience which are coming. I want to keep a balance between basic and thoda advanced. But then if you want any specific things to be covered, specifically in some kind of a module shape, well, we are happy to have your feedback.
Specific things, like I've been an investor for 25,
Correct, sir.
30 years. So now everybody is saying part of your portfolio should also be foreign holdings.
At least I am not saying.
You mentioned a NSE IX fund.
Correct.
I would like to know a little bit about
Sure.
that.
So,
Secondly, how we can hedge the risk. I believe that you have something like LEAP or something.
Yeah.
So we'd like to know a little more about
so
Okay.
the idea is, so we wrap up
Yeah.
this session. Thanks so much, Joe. The idea is to have at least one session per month. So there will be, like Suresh sir was saying, there will be a tweak in timings, let us say, in the daytime, in the late afternoon, evening. Then once in a quarter to assemble for the policy dialogue with a policy maker. That's the overall curation. So insofar as feedback is concerned, we'll definitely cover what you have mentioned. So, but just write, I request all members present here to write to HLC, Habitat Learning Center, HLC@indiahabitat.org. So Habitat Learning Center is taking the initiative, and I'm grateful to Geeta ji and our entire team for putting together this in reasonably short time, because Director Sir's instructions was we should launch this soon. Extremely grateful to that team. So this is their email ID, HLC@indiahabitat.org. HLC.
That's the Heritage Learning Center.
Yeah. So at indiahabitat.org. So we'll be in touch. We'll also keep involving regulatory officials from SEBI as well. And like Director said, we are also initiating this for the first time. So once your feedback comes in, we'll be able to also curate it very specifically. Thank you, Suresh sir, once again. Thank you to all the esteemed members and audience present here. Thanks to Team NSE for patiently organizing this also. Until next time, thank you very much.
Thank you. It was a good session. Good session.